नमस्कार दोस्तों, आप सबको अपना चैनल ध्वज स्टॉक इन्फो में बहुत बहुत स्वागत है। वेलकम बैक टू द इंडियन स्टॉक मार्केट सीरीज। In the last 3 episodes we have covered what the stock market is, how to pick winning stock using 7-point checklist, and now you have already built your first portfolio. Today we go one level deeper. You have picked your stocks, but do you actually know what is happening inside these companies? That is exactly what the annual report tells you. And today I am going to show you how to read one in simple language. No MBA is required. Okay, imagine two doctors gave you medicine. One says, trust me, I know what I am doing, and the other shows you test reports, x-rays and diagnosis. Which doctor do you trust more? The stock market is just like that. Every listed company in India must publish an annual report every single year. It is the company's complete health report. Blood pressure, heartbeat, bones, all the reports are available here. And most retail investors never read it. That is your biggest edge. Today I will teach you exactly what to look for in this episode. This annual report document is right here. This is company's annual report. It is 200 to 300 pages long. Most people see it and run away. But here is what professional investors know. You do not need to read all 300 pages. You only need to read 5 specific sections. That's it. 5 sections. In this video I will show you exactly which 5, what to look for in each one, and how to spot warning signals before they destroy your investment. So we shall study about what is an annual report. Every company listed in Bombay Stock Exchange or a national stock exchange must publish an annual report once in a year. Think of it as a company's report card sent to all the shareholders. It tells you what the company did in the past year, how much money it made, where it spent that money, what are its plans are, and any risk it is facing. You can download a company's report for free from their official website or from Bombay Stock Exchange website. It costs you nothing and it tells you everything. So we shall see the ways to do that. Where do you find it? For free. Go to any company's official website you want to download. Under Investors Relations section, you will find that annual report. Download it. Or Bombay Stock Exchange India website, bseindia.com. Go to that website, search under company's name. You will get the annual report. Or if you go to National Stock Exchange India website, nseindia.com, here also it will be available. Or the best thing is screener.in. Direct links to all the annual reports are available here. You can see 5+ years of data in that screener.in app. You can see, compare, study in detail about the company here. And then money control filing section is also there. Okay, then what about this annual report? What it contains? It contains chairman's letter to shareholders, director's report, financial statement, notes to the account, auditor's report, plus management discussion and analysis. Now I know what you are thinking. 300 pages sounds terrifying, but here is the truth. You need to focus on just 5 sections. Everything else is supporting the detail. Let me show you exactly which 5 sections matter and what to look in each one. Here is your annual report, reading framework. 5 sections. Each one answers a specific question. Master these 5 and you will understand any company better than 90% of the retail investors. We shall see. Section 1 is chairman's letter. Key questions. Is management honest and clear? Then what to look for? Tone. Promises versus reality check. Then comes profit and loss account statement. What to look for? What is the question here? Is the company making money? Then what to look for? Revenue growth and profit margins. Then comes balance sheet. Key question is the company financially healthy? What to look for? debt levels, asset versus liabilities. Then cash flow statement. Key question here is the real cash coming in? What to look for? Operating cash flow, the truth teller. Then management discussion. The key question is, what are the risks and future plans of the company? What to look for? Honest risk disclosure, growth strategy. Now we shall discuss all these things. Chairman's letter to shareholders. This is a letter written by the chairman directly to the investors. It is usually 3 to 5 pages long. Read it carefully. It tells you what happened this year, why profits went up or down, and what the company plans to do next. The chairman's letter is the most underrated part of any annual report. Here is the powerful trick. Compare what the chairman said last year with that of the actually happened this year. If the promised 20% of the revenue growth and delivered only 8%, that tells you something important about the management quality. Honest management will openly explain what went wrong. Dishonest management will give you excuses or simply not mention their failed promises at all. You have to observe for some green flags in the annual report, which are called as good signs. How to identify them? Acknowledge failures openly, give specific future targets, matches last year promises, explain challenges clearly. These you can list as green flag. Then what about red flags or warning signals? My company only talks about achievements, vague language, we will try like that, and never mentions past promises, blames only external factors. This is the indication of red flag or warning signs of the company. Then next section, profit and loss account. This tells you how much money the company earned and how much it spent in the past year. 3 numbers matters most: revenue, operating profit, EBITDA, and net profit. Look at 3 to 5 years of the data, not just 1 year. Think of profit and loss account like your personal salary statement. Revenue is your total salary, operating expenses are your rent, food and other travel. What is left after all these expenses is your profit. A healthy company should always consist growth in all the 3 numbers over 3 to 5 years. 1 good year means nothing, but 5 good year means everything. Now in the profit and loss account, in line number 1, revenue, it is the top line. What it means? The total sales of product of services of the company. Healthy sign is growing 10 to 15% plus year, and warning sign is flat or falling revenue always. Then comes gross profit margin. What it means? It is revenue minus direct costs of the company. Healthy sign is stable or improving margin, and warning signal is shrinking margin year on year basis. Then EBITDA margin. EBITDA margin, what it means? Operating efficiency of the business. Healthy sign is above 15%. Ideally 20% plus is very good, and if the growth is below 10%, it is declining or a warning signal. Then comes net profit. What it means? This is the final profit after all cost and tax. Healthy sign is growing consistently for the past 3 to 5 years. Warning signal is profit despite falling revenue. This is the important thing. Then EPS, that is earning per share. What it means? Profit per share you own. Then healthy signal is rising EPS, more value for you. Then if it is a warning signal, falling EPS, that is dilution of our risk. Then if a company revenue is growing but net profit is falling, costs are rising faster than the sales, that is a serious warning sign. Always check both. Then the next section is balance sheet. Balance sheet is a snapshot of what company owns, assets, versus what it owes, liabilities, on one specific date. The difference between the two is called shareholders' equity, your share of company's net worth. Then think of a balance sheet like your kitchen. Assets are everything you own, your fridge, your groceries, your utensils. Liabilities are what you owe. Then the loan you took to buy the fridge, equity is what you truly yours after you pay off all the loans. A healthy company owns more than it owes. It is as simple as that. What to check? Debt to equity ratio. What it tells you? How much loan versus owner's money. And ideal benchmark is below 1 always. And if it is zero debt company, it is very good. Then comes current ratio. Can the company pay short-term bills? Ideal benchmark is 1.5. This means it is comfortable. Then comes return on equity. What it tells you? How efficiently money is used. Ideal benchmark is above 15% consistently. Then comes return on assets, ROA. What it tells you? Profit from the total assets, and ideal percentage should be about 8 to 10% is healthy. Then reserves and surplus. What it tells you? Retained profit over the years, and the ideal benchmark is growing year on year basis. Then the next item is cash flow statement, the most important one. This is the section most beginners skip, and it is the most powerful. Cash flow shows you actual real cash moving in and out of the business. The company can profit on the paper while actually running out of cash. Cash flows does not lie. Here is the fact that will surprise you. A company can show profit in its profit and loss account, still go bankrupt. How? Because profit is an accounting number. It includes sales that have not been collected so far. Cash flow only counts the real cash in the bank. This is why professional investors always look at the cash flow first. If operating cash flow is negative or for 2 or more years, be very careful with that company. Then the items to look in the cash flow are operating cash flow. What it means? Cash flow from core business and operations. Healthy pattern, positive and growing, most important. Then comes investing cash flow. Here cash spent on expanding the business. Healthy pattern is negative is okay. Means investing in growth. Then another type of cash flow is financial cash flow. Here what it means? Cash from loans or dividend payments, and healthy pattern is negative okay if paying off the debt. Then comes free cash flow. What it means? Operating cash minus capital spending. Healthy pattern is positive FCF is equal to company generates real cash. Critical rule: if profit is high but operating cash flow is negative, this is a major red flag. It means the company is booking sales it has not actually collected. Investigate further before investing. Then comes management discussion analysis, MD&A. In this section, the management team gives you their view of the business, what went well, what challenges they face, and what their plans are for the next 1 to 3 years. It also includes mandatory risk disclosure section. The management discussion analysis section is where management speaks to you directly in plain language. Read the risk factors sections carefully. Every company must disclose the risk that could hurt their business. If a company lists increasing raw material cost as a risk, check whether the risk actually affected the profit this year. What management's risks warning match reality. When management's risk warnings match reality, it means they understand their own business well. That is the sign of the honest, aware leadership. What good MDA looks like? Specific numbers and targets given. Then honest discussion of challenges. Clear explanation of margin changes. Detailed sector specific analysis and future capex plans clearly stated. What bad MDA looks like? Generic statements like we will grow, no mention of challenges or setbacks, copy paste from the last year's report, risks listed but never discussed, no specific targets or timeline given. These are very bad MDAs. Then one more check, the auditor's report. There is one more thing I want to check, and it takes less than 2 minutes. Find the auditor's report. This is written by an independent auditor, not company. Look for two specific things. First, did the auditor give a clean opinion or a qualified opinion? A clean opinion means the accounts are accurate. A qualified opinion means auditor has concerns. Second, look for any key audit matters flagged. These are issues that the auditor found important enough to highlight. Take them seriously. What is a clean opinion? The financial statements give you true and fair view. This is what you want to see. Means accounts are verified and accurate, safe to proceed with your analysis. What about qualified opinion? Means except for matters described below, this is a warning. Means auditor has concerns. Dig deeper before investing always. Then comes your 10-minute annual report checklist. Very practical. I want you to be able to open any annual report and complete your analysis in 10 minutes. Here is exactly how to do it step by step. 1 to 2, what to read, chairman's letter. Questions to answer is management honest and accountable. Time spent will be 2 minutes. Then profit and loss account, 5 years trend you have to see, and what to see is revenue and profit is growing. It will take only 2 minutes for you. Then comes balance sheet. What to see is debt is low or assets are growing. Here also it takes only 2 minutes. Then comes cash flow statement. Is operating cash flow is positive? This also takes only 2 minutes. Then management discussion analysis, risk section. What to see here? Or risk disclosed honestly, it will take only 1 minute. Then you can go to auditor's opinion. You have to see what to see here, clean or qualified opinion given by the auditor. This also takes only 1 minute. Then that's it. 10 minutes, any company, anywhere. Once you do this 3 or 4 times, it becomes second nature, and your stock picks will be 10 times more confident because you actually know what is happening inside the company. I want to show you one live example of TCS annual report. Let me show you this section. I am going to open a TCS latest annual report right now, live on screen. Now we are seeing the TCS annual report here. I have gone to the tcs.com. Through this navigation, I have downloaded this TCS annual report. This annual report is about 336 pages. You can see them. Mr. Ratan Tata's photo is there, and the contents of the TCS, about TCS, board of directors, management team, everything. What are the contents here? They have written here. Then comes about TCS. What about TCS? They have written here. It has its presence in 6 continents, 152 nationalities, and 607,000 associates they have. This is the America map, South America and North America, presence of TCS in both the countries. Then you can see the presence of TCS in the world map. This eastern side, this is Europe, Africa, Australia. It's present in all the places, and here Cambodia, Thailand and all. This is the board of directors of TCS. And the management team details are here. Letter from the chairman. This is the letter from the chairman to the shareholders. Yes, addressed like that only. Dear shareholders, see this pages roughly. You can go through the important points in this. Then comes letter from the CEO. Then comes quarterly previous quarter results. Final dividend, it has declared 30 per share with 126 per share it is. Quarter 3, quarter 2, all the results and the main features are shown here. Latest photos and all, awards and associates by the TCS. Like this, you have to go through leisurely, and what are the times criteria given in my video, please go through it and complete the annual report at the earliest. Now more than this, you can go to the screener app and see how it is. Go to screener app and explore. Here if you type TCS, you will get here, click on this TCS menu. Here you can see the details, data of the TCS. Market capitalization is 9,13,314 crores. Current price is 2,524. High and low are 3,630. Low is 2346. Stock PE is 17.4. Book value is 296. Dividend yield is 2.38%. ROCE is 63.4%. ROE is 52.1 and face value is 1 rupee of share. See the stock movement of the TCS. It has peaked 3004. After that it has come down to the current level 2534. Pros and cons you can see a peer comparison here. TCS is in the top because it is having the highest market capitalization. Dividend yield is 2.3% and ROC is 63.35. Then comes Infosys Technology, HCL, etc. Then quarterly results you can see March 2023 to March 2026 available. Sales, it is starting from 59,162 crores to it has gone up to 70,698 crores. Then net profit margin, operating profit, profit before tax and net profit margin, it starts from 11,436 to 13,780 crores. Profit percentage. EPS is during March 2023 31.13, now it is 37.92. Profit and loss. Sales, see sales is improving from 94.646 crores to present 2,67,021 crores. Net profit is 49,454 crores as on date. And EPS is 136.01. Dividend payout 8.81%, highest dividend. Then compound sales growth in 10 years, the sales growth is 9%. If you take for last 5 years average, it is 10%, and last 3 years average is 6%. TTM is 5%. Then profit growth, compounded profit growth, 10 years 8%, 5 years average is 10%, 3 years average is 8%, TTM is 8%. See, like this it goes. Return on equity is in last 3 years 52%, highest. In last year also it is 52%. Then comes balance sheet. See, equity capital was 196 crores in 2015. Now it has touched 362 crores. Then reserves and surplus 106,878. It has started increasing every year. Started from 50,439 crores. It has grown up, almost doubled. Then cash flow, you can see cash flow from operating activities 52,094 crores positive, and cash flow from investing activities minus 12,845. This is okay. Investing activities, it should be minus always. And then cash from financing activities also good, minus 42, 133. Yeah. Now last and final is closing and call to action. So that is how you read the company's annual report without an MBA, without a finance degree, and just in 10 minutes. 5 sections, 1 checklist, and you now know more about a company than most retail investors who simply look at the stock price and buy. Remember, price tells you what the market thinks today. The annual report tells you what the company actually is. Always trust the report over the price. Then call to action. Here is your action step for today. Pick any company from your current portfolio or watch list. Download the latest annual report, run the 10-minute checklist, come back to the comment section and tell me, did it pass or fail? I read every comment. Now, if this video gives you value, please like it, share it with one friend who invests, and subscribe for the next episode. In the episode 5, we are going to cover something very exciting, technical analysis basics, how to read stock chart. You will not want to miss that one. See you next week. Thank you. Thanks for watching.